Tech giants like Alphabet and Amazon are aggressively hiking their 2026 and 2027 capital expenditure budgets, signaling that the massive spending spree on artificial intelligence infrastructure is only just beginning. This analysis examines the specific hardware leaders positioned to capture this sustained surge in data center investment. By the end of this video, you will know which three dominant companies are best positioned to profit as the AI infrastructure market continues to expand. While recent market volatility had many investors fearing an imminent slowdown in artificial intelligence infrastructure, the underlying numbers tell a completely different story. The capital is flowing, the demand is locked, and a massive supply bottleneck is about to make one of these hidden players incredibly wealthy. But which of these three holds the ultimate trump card for the next phase of this computing revolution? The first of these three giants, and the undisputed anchor of the entire computing movement, is NVIDIA, ticker symbol NVDA. When I look at the sheer scale of the hardware ecosystem being built today, all roads lead back to their silicon. But there is a massive disconnect between how the market is pricing this company and the actual fundamentals on the ground. Right now, the stock is trading at a forward price-to-earnings ratio of just 16 times fiscal 2028 analyst estimates. For a company growing at this velocity, that is an eye-watering valuation. It suggests that many investors are treating this generational infrastructure build-out as a temporary spike rather than a permanent architectural shift. If you dig beneath the surface of their financial reports, you quickly realize that their dominance is not just about making the fastest graphics processing units. It is about a deeply entrenched, multi-layered ecosystem that is virtually impossible for competitors to displace. Let's address the elephant in the room. Why can't competitors like AMD or Intel simply build a chip that is 10% faster and steal NVIDIA's market share? The answer lies in a software platform created nearly 2 decades ago called CUDA. Compute Unified Device Architecture is the software layer that allows developers to program NVIDIA's graphics chips directly. Over the last 18 years, CUDA has become the industry standard. Almost every major foundational artificial intelligence model is written, optimized, and deployed using CUDA. Think of it like an operating system. If you build a new smartphone with incredible hardware but no apps, nobody will buy it. Similarly, even if a rival chip designer produces a technically superior piece of silicon, a software engineer cannot easily run their existing AI code on it without rewriting years of work. This creates a software-driven competitive moat that is as wide as it is deep. It turns hardware into an ecosystem, and once an enterprise enters that ecosystem, leaving it is a logistical nightmare. But the story does not stop at the individual chip level. As the size of these machine learning clusters scales up to tens of thousands of interconnected processors, a physical limitation emerges. How do you get thousands of chips to talk to each other without bottlenecking the entire system? This is where NVIDIA's networking portfolio comes into play, acting as the critical nervous system of the modern data center. Through technologies like InfiniBand and their custom Spectrum-X Ethernet platform, they have engineered end-to-end server solutions that manage the complex traffic flow between chips. It turns out that raw computing power is useless if the data is stuck in transit. By controlling both the brain, the chip, and the nervous system, the network, they can optimize data delivery at a level their competitors simply cannot match. This integrated approach has transformed them from a component vendor into an indispensable infrastructure monopoly. We are also witnessing a fundamental shift in how artificial intelligence operates. We are moving away from simple chatbots that answer prompts and moving toward autonomous agents. These are systems capable of executing multi-step tasks, browsing the web, and making decisions on their own. This rise of agentic AI requires a different kind of computational architecture. While graphics chips excel at the parallel processing required to train neural networks, autonomous agents need central processing units and data processing units to handle sequential logic and manage massive streams of incoming data. NVIDIA has anticipated this shift by developing their own custom CPUs and DPUs. By integrating these different processors into a single, cohesive system, they are ensuring that their hardware remains the default choice, regardless of how the software layer evolves. Perhaps the most brilliant strategic move they have made, however, is their acquisition of Grok and its language processing units, or LPUs. This acquisition directly addresses a major structural hurdle in the industry, the massive transition from training models to running them in production, a process known as inference. Training a model is like writing a textbook. It requires an immense amount of computational power, but you only do it once. Inference is like reading that textbook and answering questions. It happens billions of times a day and demands lightning-fast response times. LPUs are fundamentally different from traditional graphics processors because they feature static random access memory, or SRAM, embedded directly on the chip itself. This architectural difference has profound implications for how models are run. To understand why this SRAM integration is so revolutionary, we have to look at the two distinct phases of running an AI model, the prefill phase and the decode phase. When you type a prompt into an AI, the system first has to read and process your entire input. This is the prefill phase. It is a highly compute-heavy process, and traditional graphics processors packaged with high-bandwidth memory are incredibly efficient at handling it cheaply. But once the system understands your prompt, it has to generate an answer. This is the decode phase, where the model outputs text one single word at a time. Because each new word depends on all the words that came before it, the system has to constantly access its memory. This is where memory bandwidth becomes a massive bottleneck. Because LPUs have SRAM built directly onto the silicon, they can access data almost instantaneously, making them the ultimate tool for the latency-sensitive decode phase. By combining traditional graphics chips for prefill and LPUs for decode, NVIDIA has built a dual-threat architecture that dominates both ends of the inference spectrum. It is a masterclass in strategic positioning. This dual approach raises a vital question. If high-bandwidth memory remains the crucial link that allows traditional graphics processors to handle the massive prefill phase of inference, who actually controls the supply of this precious memory? The hardware cannot function without it, yet producing it is one of the most complex engineering challenges on Earth. This brings us to a massive supply bottleneck that is quietly dictating the pace of the entire global technology rollout, and the single company that has managed to corner this critical market. If this resonates with you, you're exactly who this channel is for. Please, hit the like button, share the video, and leave your thoughts in the comments. Subscribe to the channel so you don't miss out on the next important financial investing update. To understand how the memory bottleneck is shaping the future of computing, we have to look at the undisputed leader of the high-bandwidth memory market, SK Hynix, ticker symbol SKHY. While most of the mainstream media attention is focused on the processors themselves, those processors are effectively useless without specialized memory to feed them data. High-bandwidth memory, or HBM, has become the single biggest bottleneck in the entire artificial intelligence infrastructure segment. As processors grow faster, they require an increasingly massive fire hose of data to keep their computing cores active. Traditional memory technologies simply cannot transfer data quickly enough, creating a digital traffic jam that wastes energy and slows down performance. HBM solves this by stacking memory chips vertically and connecting them directly to the processor, dramatically reducing latency and improving power efficiency. This packaging is especially critical for inference, where real-world applications demand split-second response times. But if HBM is so essential, why doesn't the industry simply manufacture more of it? The reality is that producing HBM is a manufacturing nightmare. It requires up to 3 times the physical wafer space of ordinary dynamic random access memory, or DRAM. To put that in perspective, every time a memory manufacturer decides to produce a single gigabyte of HBM, they are sacrificing the potential output of 3 gigabytes of standard memory. This wafer penalty severely limits the global supply capacity. Furthermore, the specialized manufacturing equipment required to assemble these complex 3D stacked memory architectures is incredibly rare. The big 3 DRAM makers are actively competing for the exact same advanced lithography and packaging machines that logic chip giants need to build their processors. It is a physical constraint of global industrial capacity. You cannot simply write a check to solve this. You have to wait in line for the machines that build the machines. In this supply-constrained environment, SK Hynix has established an incredibly dominant position, controlling over 50% of the global HBM market. They are not just a supplier, they are the primary indispensable partner to NVIDIA. This relationship was recently cemented in a jaw-dropping $500 billion multi-year supply agreement. Let that number sink in. A $500 billion commitment guarantees that SK Hynix's production lines will be running at absolute maximum capacity for the foreseeable future. Because NVIDIA's next-generation architectures are designed in tandem with SK Hynix's memory roadmaps, the integration is incredibly deep. It is a level of codependence that makes it incredibly difficult for any rival memory maker to steal their market share, even if they manage to scale their own production. This structural supply deficit gives SK Hynix an extraordinary level of pricing power. Unlike the historical memory market, which has been notoriously cyclical and plagued by brutal price wars, the current HBM landscape operates under entirely different rules. SK Hynix is signing long-term contracts with major tech buyers that feature no price caps. This means if manufacturing costs rise, or if market demand spikes even further, they can pass those costs directly to their customers, preserving their massive profit margins. Because the broader DRAM market is projected to remain in short supply for the next several years, the company is insulated from the typical boom and bust cycles that have historically made memory stocks highly volatile. They have effectively transformed a highly commoditized business into a specialized, high-margin monopoly. Yet, despite this unprecedented fundamental strength, the public market seems to be completely mispricing the opportunity. SK Hynix is currently trading at a forward price-to-earnings ratio of just a little more than 5. A PE of 5 is typically reserved for companies in terminal decline, heavily indebted businesses, or cyclical steel manufacturers at the absolute peak of their cycle. It represents an extreme level of market skepticism. My view is that the market is failing to realize that HBM is not a temporary fad, it is a permanent architectural requirement for the next decade of computing. When you can buy the dominant supplier of the industry's most critical bottleneck at a single-digit earnings multiple, you are looking at one of the most asymmetric risk-reward profiles in the entire technology sector. But this deep dive into the silicon supply chain reveals one final, ultimate vulnerability. NVIDIA can design the most advanced processors in the world, and SK Hynix can stack the most sophisticated memory modules next to them, but someone actually has to physically manufacture and package these hyper-complex components together. There is only one facility on the entire planet that has proven it can do this at scale with the precision required to keep global tech giants running. If that single link in the chain falters, the entire global artificial intelligence build-out grinds to a halt. Who is this ultimate gatekeeper of the modern digital world, and how are they leveraging this absolute monopoly to secure their financial future? This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks, but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. This brings us to the absolute linchpin of the global technology sector, Taiwan Semiconductor Manufacturing, ticker symbol TSM, commonly known as TSMC. To understand their importance, you have to understand that designing a chip is entirely different from actually building it. A company like NVIDIA can spend years designing a revolutionary architecture, but those designs are just blueprints. Translating those blueprints into physical silicon with billions of microscopic transistors spaced mere nanometers apart is an extraordinarily difficult physical challenge. In the semiconductor industry, the ultimate metric of success is yield, the percentage of usable chips produced from a single silicon wafer. If your manufacturing process has low yields, your costs skyrocket and you cannot meet demand. TSMC is the only foundry on Earth that has consistently proven it can manufacture the most advanced chips at high yields and massive global scale. This technical execution has given them a virtual monopoly in advanced node manufacturing. How did they achieve this absolute dominance? It is a combination of astronomical capital expenditure and decades of accumulated manufacturing expertise. Building a modern leading-edge semiconductor fab costs upwards of $20 billion. It requires extreme ultraviolet lithography machines that cost hundreds of millions of dollars each, operating in clean rooms that are thousands of times cleaner than an operating room. But money alone cannot buy TSMC's level of execution. It requires a highly specialized workforce and decades of fine-tuning chemical, physical, and optical processes. Competitors like Intel and Samsung have spent tens of billions of dollars trying to catch up, yet they continue to struggle with yield issues on their most advanced nodes. This has created a massive competitive moat protected by the laws of physics and sheer capital scale. If you want the best chips in the world, you have no choice but to go to TSMC. This virtual monopoly grants TSMC an extraordinary level of pricing power. In a typical supplier relationship, large buyers can squeeze margins by threatening to take their business elsewhere. But where else is NVIDIA or Apple going to go? There is literally no alternative. As a result, TSMC can dictate pricing terms across the entire industry. When manufacturing costs rise due to inflation, energy prices, or complex new packaging technologies, TSMC simply passes those costs along to their customers. This pricing power is reflected in their robust gross margins, which consistently hover above 50%. They are effectively running a toll road on the global digital economy. Every single advanced artificial intelligence chip going into every data center on Earth must pass through their factories, and TSMC collects a premium toll on every single one. The demand for TSMC's services is only accelerating as chips proliferate throughout global data centers. But the bottleneck has shifted from raw silicon fabrication to advanced packaging. Today's AI systems do not just use standalone chips, they use complex multi-chip modules where the GPU and high-bandwidth memory are packaged together on a single substrate. TSMC's proprietary advanced packaging technology known as chip-on-wafer-on-substrate, or CoWoS, has become the new critical constraint of the entire supply chain. To address this, TSMC is aggressively building out its advanced packaging capacity worldwide. They are investing billions to build new facilities, ensuring they can meet the surging demand from customers who are desperate for more hardware. This aggressive expansion guarantees that TSMC will remain the central hub of the semiconductor ecosystem for years to come. From an investment perspective, the stock is trading at an incredibly attractive valuation given its growth outlook. It is currently valued at roughly 19 times 2027 analyst estimates. For a company that sits at the center of the global technology universe, possesses an absolute monopoly on advanced manufacturing, and boasts massive pricing power, a forward multiple of 19 is highly compelling. It reflects a broader market discount that is largely driven by geopolitical anxieties rather than operational fundamentals. While geopolitical risks are a real factor when investing in Taiwan, the operational reality is that TSMC is making itself completely indispensable to the global economy. They are building new fabs in Arizona, Japan, and Europe to diversify their geographic footprint, all while maintaining their technical lead. When you look at these three companies together, NVIDIA, SK Hynix, and TSMC, you begin to see a complete, self-reinforcing trifecta that forms the bedrock of the artificial intelligence revolution. They are not competing against one another. They are deeply codependent partners in a massive multi-billion-dollar supply chain. But what happens when we look at the broader macro picture? If tech giants like Alphabet and Amazon are committed to spending even more in 2027 than they are today, how should we look at the current valuations of these three key players, and what does this mean for the future of your portfolio? The sheer scale of the capital expenditure we are witnessing from hyperscalers like Alphabet and Amazon is almost difficult to comprehend. These companies are not just buying hardware, they are building the foundational infrastructure for the next 50 years of human productivity. When these tech giants increase their capital budgets for 2026 and signal even higher spending in 2027, they are sending a clear message to the market. The transition to artificial intelligence is a permanent paradigm shift, not a temporary trend. This capital spending spree is creating an unprecedented windfall for the companies that control the physical components of this new digital world. The most compelling aspect of this narrative is the current valuation of these critical enablers. Because of short-term market anxieties and fears of an infrastructure overbuild, many of these stocks are trading significantly off their recent highs. NVIDIA at 16 times fiscal 2028 estimates, SK Hynix at a forward PE of just over 5, and TSMC at 19 times 2027 estimates represent an extraordinary valuation disconnect. The market is pricing these companies as if their earnings are about to collapse, even as their largest customers are publicly committing to spending more money next year than they did this year. This is the definition of an asymmetric investment opportunity, where the fundamental reality on the ground is vastly superior to the prevailing market sentiment. As this infrastructure boom continues to play out, the winners will not necessarily be the software applications built on top of these models, many of which have yet to find viable business models. The true guaranteed winners are the picks and shovels providers that make the entire ecosystem possible. By focusing on the hardware layer, specifically the design leaders, the memory gatekeepers, and the manufacturing monopolists, you are positioning your portfolio to capture the direct flow of capital from the wealthiest corporations on Earth. The infrastructure supercycle is well underway, and the foundation has never looked more secure. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the StocksGalore Patreon today and take your investing game to the next level. Our members get full in-depth analysis on most of the stocks mentioned here. Head over to patreon.com/StocksGalore and become part of our growing community of smart investors. Link is in the description. If you made it this far, you are the reason I make these. Make sure to like the video and subscribe to the channel. See you in the next one.